All right, everybody, welcome to today's training. Today, we're going to talk about indexed universal life, IULs. And the key elements of an IUL is protection, growth, and tax-free. Those are the hot buttons and the buzzwords. By the time this training is over, you will know the product, you will know who the right people are, and you will know how to position it. So let's jump into IULs. What exactly is an IUL? Well, an IUL is what you would get if a 401k and a life insurance policy had a baby. It would be called IUL. IUL is a permanent life insurance, but here's the cool thing. They build cash value, and that cash value grows tied to a market index like the S&P 500. But here's the cool thing, because as soon as you say tied to the market, people think about losses. Well, an IUL has a floor, a minimum that protects you from losses. So what does that mean? It means you participate when the market gains, but you do not participate when the market loses. You get to stand on the sidelines and let everybody else take the losses. Now, how is that possible? The insurance company is taking a slice of the upside in exchange for that floor guarantee. That's the trade-off. And for most clients, that is a fair trade. I want you guys to think of it as an upgrade. There was a product called Universal Life. It still exists. It worked, but it has limits. The IUL, it's better because it captures more interest. It has better downside protection. And it includes, check it out, a built-in retirement income strategy. So the mechanics are significantly better. So again, the highlights, the growth is linked to the market. There's a floor of protection, and there's a built-in retirement engine. What are the four things that an IUL does? And if you're watching this video, if you're attending this training live, these are the four things that you want to be able to clearly articulate to a prospective client. And you want to keep it this simple. It's seventh grade. It's just a handful of statements, and this is going to help people get there. The first thing that an IUL does is it protects your family. There is a tax-free death benefit if you don't make it home. Okay, so that's the first part. The second thing it does is it protects you from market risk. There's a cap, there's a floor. You get your gains every year, but you never lose money. There's up years, you get credit, bad years, the worst case you get is a zero, depending on the product. Third thing it does, it protects you from unnecessary taxes. The money in the IUL, the cash value, is growing tax deferred. Okay, you can actually use it for income as you go through the years of the policy by means of policy loans, which are not taxable. Okay, so you pay taxes today on the money, but you access it tax-free tomorrow. Now, the last thing that an IUL does, number four, is it protects you from outliving your money. And that's a very, very serious concept and a very, very big value. So there's built-in safeguards to make sure you don't run out of money while you're alive. Okay, there are no forced distributions. There's no early withdrawal penalty. It does all four of these things at the same time. And for you as a financial professional, sharing the IUL concept with people, this is what makes you incredibly competitive. All right, let's talk about the floor and the cap. Okay, one of the products that we recommend is one of the IUL products that we work with, I should say, is F&G Quantum. In the case of F&G Quantum, the cap is 12% and the floor is 0.25%. So let's compare that to the S&P. All right. In 2005, the S&P grew by 4.91%. That means that if you were in F&G Quantum, your cash value would have grown by 4.91%. In 2006, the S&P 500 grew by 15.79%. If you were in F&G Quantum, you would have hit the cap. Your money would have grown by 12%. 2007, 5.46% for the S&P, 5.46 for F&G Quantum. But here's the big one, folks. And I'm sure you all remember that in 2008, the market took a big tank. It went down 37%. People were crying. If they had $100,000 in their 401k, now they had just a little bit more than 60. But people who were in F and G Quantum or in an IUL had zero loss. In the case of F and G Quantum, they actually had a tiny gain, 0.25%. Now the market did come back in 2009 and went up 26%. And again, that would hit the cap. And if you had your money here in this IUL, you would have gained 12%. So over 25 years, here's what's happened. The S&P average over 25 years is 6.81% because you're averaging the up years and the down years. And believe it or not, there were several down years. IUL clients with a 12% cap and a 0.25% floor would have averaged between 7.08% and 7.34%, meaning they would have actually beaten the market because the downside protection is going to produce a better net result because there are no down years. And that's that floor being absolutely amazing, protecting your retirement instead of being fully in the market. So let's compare an IUL to a 401k, okay? And the question that you should ask your client, this is one of the questions you want to write down, and you want to remember, and you want to ask is, you want to know how many of my clients have lost money in an IUL in the last 18 years? None, right? Now, when comparing an IUL to a 401k, when it comes to taxes on the growth, 401k money grows tax deferred, IUL growth grows tax free. Taxes on withdrawal, 401k, when you take the money out, you are fully taxed at the future rate. Here's a question. Do you guys think taxes are going to go up or down in the future? Up. So that means that you're going to pay more taxes, higher taxes on that money when you finally take it out of your 401k. Whereas with an IUL, when that money comes out, it's tax-free because you're going to use it policy loans. What happens if there's a market loss in your 401k? Deal with it. In your IUL, there's no loss because there's a floor. What about contribution limits? The IRS says there's a limit to how much money you can put in your 401k. But if you properly design an IUL, there are no limits. Is there a death benefit for your 401k? No. In an IUL? Absolutely. And it is tax-free. Are there living benefits in a 401k? No, but there are in an IUL. Are there RMDs at 73, required distributions? Absolutely with a 401k, not at all for an IUL. Can you access it before 59.5 years old? Sure you can with a 401k, but you're going to pay a 10% penalty. IUL, no penalty at any age. Can you outlive your money with a 401k? 401ks don't offer any protection for that, but IULs offer a built-in safeguard. Now, are we anti-401k? No way, right? Especially if you have a situation where the employer is matching it, why not take the free money? But anything that's not matched or anything above the match should be going into an IUL. So how do you get there? You ask questions. You ask questions. And the quality of your questions is going to determine the quantity of your paycheck. Remember, you're a financial professional, so you do your due diligence. Now, you're not just a salesperson with a pitch. You're trying to help this person, right? When you go to the doctor, you don't walk in and say, give me medication. They ask questions first, diagnose, and do what's appropriate. That's how we do it here. So here's what we ask. What do you have going on for retirement right now? Are you contributing to a 401k? And is any of that unmatched? Do you have any concerns about what taxes are going to look like when you retire? If the market dropped 40% the year before you retired, what would that do to your plan? Do you have anything in place to protect your family if you don't come home? Do you have anything in place to protect your income if you can't work? Now, by the way, folks, unmatched 401k dollars are the single best IUL opportunity on every call. What does that mean? It means if somebody is contributing $500 a month to their 401k and their company only matches up to 250, that other 250 above it should be that. We need to take that and put that in an IUL. Okay. We show them how to do that. and adjust for taxes. Okay. Now, let's talk about age related to IULs. And I'm going to tell you what, guys, age is everything. When it comes to an IUL, yesterday was the best day to do it. Today's better, and tomorrow, hurry on up. Okay. So, this is the most urgent conversation you're going to have. It's going to be more expensive tomorrow, and it's not going to just be more expensive from the cost of insurance. It's one less year that it compounds, and you cannot buy that back, right? So this is why this is such an incredible opportunity. If you're talking to folks that are in their 20s, they have the opportunity for over 40 years of compounded growth. They're healthy. They're going to get the lowest premiums. They're going to get the highest death benefits, right? And we're going to talk about starting when you're a child in a minute. That's going to blow you away. If you're in your 30s, you're still good, right? You still got a good time, but the clock is ticking. If you're in your 40s, you have to do it now. You can't wait, not next month, right this second. If you're 45, you got 22-year window. The premium is higher, the cost of insurance is going up, and the window is closing. It's kind of like you think about one of those movies where they're trying to get out of a room before the door slides shut. And you got to slide underneath it. That's in your 40s. That's you. And if you're in your 50s, it's Custer's last stand, folks. It's the last real opportunity to leverage this as a real retirement strategy. So time is of the essence. And as a financial professional out there serving people, you want to make sure that you understand that so you can properly communicate it. Now, one of the things that blew us away when we were having executive training and with our partners and learning how to position different things is how one of our senior partners used an IUL for college funding, right? This is one of the most missed opportunities in the business. Parents with young children, it's an incredible opportunity. And I'm going to be candid with you. You're not going to make a lot on these policies when you do an IUL for college funding. Where you're going to make the money is because of all the other policies you're going to write in that family, because of the way you help them. And all the other families you're going to get introduced to as these parents talk to their friends about the strategy that they put in place for their kids. It's going to just bring you into more households, and you're going to get a whole lot of referral business because of this. But this is just an incredible strategy, right? So number one, the cash value of the IUL doesn't count as a student asset on FAFSA, right? So if they have a savings account, they got a 529 plan, they got a brokerage plan, it all counts against them on FAFSA, but not an IUL, okay? Policy loans are going to be tax-free, so there's no income to report and there's no financial aid impact, okay? There's a death benefit, and whatever's not used keeps growing, and they can use it later in retirement, okay? And the other thing, too, is that when they borrow the money out of the policy, it doesn't come out of the policy. So you never actually deplete the asset. We'll talk about the mechanics in a second, all right? So let me tell you the story. What this gentleman did was he started his daughter's policy at 7. Okay, she was 7 years old. He said he wished he did it for his older daughter, but he didn't know about it then. So he did when she was 7. And then he contributed to that policy, that IUL, every single month. And when she was 18 and it was time to go to college, he let her take out a student loan. He didn't pull the money out of the policy. He let her take out a student loan. And you know the way student loans operate is they have a grace period. So you take them out today, but you don't start paying until 4 years and 9 months later. So now at 25, essentially, now the bill is coming due. Here's what she does. You take tax-free loans from the IUL to pay the student loan. No money out of pocket now. And here's the other thing. It's creating phenomenal credit for that child. But here's the cool thing. When you understand the mechanics of an IUL loan, how they don't take the money out of the policy, you're actually borrowing against the policy. So everything in there continues to grow. Hey, look, after the student loan is paid off, there's still money. So now in the 30s, this child is their own bank. when it comes to buying a house, when it comes to planning a wedding, when it comes to starting a business, this child doesn't have to go to a bank and get on their knees. Instead, they can borrow it from themselves against their policy. And then based on how that performs and how much they take, guess what happens in their 60s? Now there's a retirement asset. And the entire time there's a death benefit. So this is amazing. What's the best time to start? 15 days old. In the United States, Social Security numbers are issued at 14 days. At 15 days old, that's the most favorable rating that child's going to have in their entire life. That is the best time to do it. And by the way, this is a strategy of the rich and the wealthy. This is the infinite banking concept being built from birth. There's not a 529 plan that performs this way. And this is a major, major strategy. I hope as you go through this training, I hope you're writing down the names of people, friends, and family in your circle that need to know about this concept. Let's talk about how the tax-free income actually works. We've alluded to the mechanics. Let's talk about it for a second. Okay. So when the client is ready to take some income in retirement or to pay that student loan, they're going to access it through policy loans, not withdrawals. And per IRS Section 7702, loans are not taxed in the United States. So you got to look at it this way. Look at it like a bucket. The bucket is the cash value of the IUL. And there's a hose that's filling the bucket. Those are the index credits that are tied to the market. And then there's a little spigot or faucet on the bucket stuff is coming out. Those are your loan withdrawals. Okay. As long as the fill rate is bigger than the drain rate, the bucket never gets empty. Right. So if the fill rate is 10% and the loan rate is maybe 4 to 5%, then there's a net 5 to 6%. That bucket is going to keep growing even while you're drawing out of it. That's how an IUL behaves. Another analogy is to look at it like the equity in your home. Taking a policy loan is like taking a HELOC, right? A home equity line of credit. You borrow it again, you're borrowing against the asset, but you didn't sell the house, right? The house continues to grow in value. The loan is just sitting against it. You don't have to liquidate, you don't have to sell the house to access the money. All right, so let's do it with real money, real numbers. Let's suppose a client has put in $230,000 of total premium. And over the years of retirement, they take out $1.95 million in tax-free policy loans over their retirement years. And they die at age 93. Guess what? The beneficiary still gets a death benefit. The client turned $230,000 of contribution into $1.95 million of tax-free income and still left a death benefit behind. That is absolutely amazing, right? Now, of course, there's a rule of thumb. You never want to take more than 10% of the surrender value a year so that you don't make the policy lapse, but that's how that goes. Now, there's 3 types of loans for an IUL. There's a participating loan. That's the most common, which means that the loaned amount, the borrowed amount, literally stays in the account and continues to grow. This loan is accruing interest. But as long as we talked about with the bucket, as long as the policies credits are bigger than the interest, there's positive arbitrage. And even though you're accessing the money, the policy is still growing. Okay. There's also a wash loan, a preferred loan, typically available after year 10. F&G makes it available after year 10. Transamerica makes it available after year 10, where the interest rate and the rate credited are equal. So the net cost equals 0. You're literally borrowing money for free, 0 net cost. But what if do you have to repay this loan? That's one of the questions. Well, you have 3 options. Number 1, don't repay the loan. And here's what happens. The policy settles itself at death, right? The insurance company will pay themselves back out of the death benefit and whatever's left over pay to your family. Option 2, you can pay the interest only, which keeps the balance flat and preserves the death benefit. Or option 3, you can repay it in full. That's up to you. But when you do that, that's a great way of being able to really put more money in the policy. All right. Let's talk about the carriers. Let's talk about objections, and let's give you some action items. Okay. First, our carriers, when to use each one. F&G Quantum IUL, that's going to be your primary. But here's the note. Here's the thing to remember. F&G Quantum is going to work if your prospect is younger and completely healthy. It's got a lot of knockouts, okay, because it's a really aggressive policy. 12% growth, 0.25% floor. It's 99% exam free up to $1 million. There's a wash loan feature after year 10. So they put a lot of goodies into this, and they basically said, we're going to reserve this for the healthiest people. Okay. Now, what if your client has maybe some health issues? Transamerica FFIUL Express. Okay. They have 113% participation rate, no cap ceiling, wash loan after year 10, and they'll take people all the way up to age 70. Okay. By the way, you write quantum through Navigator and you go to quoting, you click on Navigator, you write Transamerica on Transamerica's page, right? There's a quick link for it there. The next fallback is Americo Instant Decision. No exam at all, up to 450,000. They take people from 18 to 70. But here's one thing to remember: they don't play in New York. Okay. Then there's F&G Path Setter IUL. Okay, now this is going to be fully underwritten. You're going to really use this, especially if a person has, just a few, they're relatively healthy, but they have some issues. Maybe they're on a few medications. Okay, you're going to go to pass that. A human being is going to review this. Their table ratings, meaning that if they're not perfectly healthy, they can still get it. They'll just pay a little bit more. All right. F&G Freedom IUL is another one, and then F&G Gold IUL. All right. If somebody is budget conscious, or if you want to write juvenile policies, F&G Gold IUL is your answers. Okay. And we'll get into some more of the hard disqualifiers when we do the how-to training on Wednesday. What are some of the things you're going to hear? I got a 401k. I'm good. Remember, questions, right? And one of the things that you're going to learn is the first response to that is congratulations. That is awesome. Commend the person for participating in their 401k. Because by the way, if you go ahead and if your first response is to knock their 401k, they're just going to be defensive and defend their 401k. So you just say, great, that's awesome. I'm glad you're doing that. But let me ask you a question. Does your 401k pay your family if you die? Does it pay you if you can't work? Does it protect your account if the market crashes the year before you retire? And you ask those three questions and you wait for the answers. And that's how you're going to help this person sell themselves on an IUL. Here's another one you're going to hear. Oh, well, I've got coverage through work. Great. Fantastic. You know what? I'm glad that you're participating in that. So many people don't check that box. Good job. However, did you know that coverage disappears the day you leave the job? And guess what happens? When you leave the job, whether that's 3 years from now, 5 years from now, 10 years from now, you're going to be older. And getting your own policy at that point is going to cost more. And you will have lost years of tax-free compounding that you can't get back. If you stay at that company for 10 years and then you leave and then you decide to do this, your money could have been growing for 10 years and you can't get those 10 years back. Here's another one. That just really sounds too good to be true. I get it. I hear you. But you want to know something? This has literally been in the IRS tax code for over 100 years. It's not a loophole. It's a legal structure that the government created. Three things: TEFRA, DEFRA, and TAMRA. Those are the laws that make this work. Last one. I need to think about it. And the only thing that changes while you think is your age and your premium, how much you're going to pay for this policy. So let's cut that time down. What specifically do you want to think about? Because if there's something that's not clear, let me answer it for you now. So as we wrap up this training, here are your action items. Number one, hopefully you've been doing this as we go. Write down 5 names. Let's start with 5. Anybody who's got a 401k, anybody who's got young children, anybody who's expressed concern about taxes or market risk. Those are your first 5 conversations. Second action item, open Navigator. Find the IUL tab, click on quoting, and go to Navigator, find the IUL tab, and play around. Okay. Click explore, quote, and apply. Click learn, demo. Just put in information, practice. Okay. I want to commend everybody who's already done that. Number three, practice those four things out loud, conversationally, without notes. Practice the 401k comparison and the tax angle questions. Let them become second nature to you, right? But when you have these conversations, maybe you'll have a little cheat sheet nearby, but you want to be able to explain those four things if we wake you up out of your sleep. Okay. Number four, pre-screen every case. All right. We're going to show you how to do this, but it's already in there. There's no magic to it. Don't be afraid of this. But if you go through the financial information form it's in the command center. If you're taking a person through the dynamic script, it's going to do it for you. All right. And lastly, make the commitment to write one IUL policy this week. We practice what we preach. I wrote my first one last week, right? I wrote an IUL on my son. And I encourage you, and why'd I do that? Because he's 26. And why am I going to go out there and promote for all the other 20 somethings to get an IUL and I don't start with my own? Okay. So you want to commit to writing an IUL policy this week. Now, here's what we're going to do on Wednesday. On Wednesday, we're going to walk you through generating an illustration. We're going to show you how to read it, how to explain it, how to understand it. But here's the most important words I can tell you today. Don't wait for Wednesday. That's what average people do. Okay, well, I'm going to wait until Wednesday. No, Gio didn't wait for Wednesday. He just went ahead and he worked his way through it. Trey didn't wait for Wednesday. And I didn't wait for Wednesday. You don't need Wednesday in order to do it. Wednesday's just going to make you better. But you know what? In the meantime, if you got one to write today or tomorrow or Monday or Tuesday, just reach out for help and one of us will help you get through it so that you could be a success story that we brag about on Wednesday instead of somebody who's just getting started.